To another Market Matters weekly video. I'm Nicholas Forsyth, Director at Market Matters, and I'm joined again by James Garrish. James, welcome.
Thanks, Nick.
James, I want to kick it off with the market. Firstly, currently at around that sort of 5.9 mark. Had a good bounce to start the day. Is now easing off a little bit just recently. Now, I guess what are our thoughts here? We've talked a lot about in the reports about how we're anticipating the market to move lower. The US market looks toppy. Our market's sort of had a bit of a dip last week and is now sort of at 5.9, as I said, and we're 32 or 33% cash, something along those lines. So what are we seeing here? What are we expecting the index to do short term?
Index level, I think it's going to be a fairly choppy May-June period. So the biggest, we call the index lower, largely on the back of selling in banks. May is the weakest period for banks. That's played out. Treasurer Scott Morrison helped with that in the budget the other night. But so the index now 5.9. I think the index is going to be a little bit choppy. We may go down to 5.8 and potentially test 5.7. So this period is a choppy one. My concern is around the US. So the US market is making all-time highs, but some of the momentum has come out of it. So we're still positioning for a 5% decline in the US market, and then that'll drag our market lower. I don't think our market will perform as poorly as the US market in a pullback. I think we're going to be somewhat insulated partially from support to the resources names, but we'll still go lower. So we've still got more of a negative bias on the market, taking opportunities as they come, but a negative bias overall for the short term.
Okay, firstly, banks. Sold CBA very close to 87, if not around 87, almost a bit high. I think we're about a day off. Also as well, we flicked ANZ on the ex-dividend date. Obviously going to receive that dividend when it gets paid in the coming weeks. Topped our NAB up a little bit and put some of that ANZ sell into the bank. Now, I guess what are our thoughts here? Obviously we sent those two alerts out yesterday. We have missed, we did miss CBA below 80. It was only there for a small period of time. And Westpac never quite got to that $32 level. Do you think we'll revise these upwards, or we're happy to sort of sit and be patient?
At this stage, I'm pretty happy to be patient, Nick. So, I think it's frustrating yesterday. I was incredibly frustrated that we didn't buy CBA below $80. We had all the intentions to. It's when we're managing money, actual money, not model fictitious portfolios, we've got to actually put the alert out, then make the transaction. And simply CBA didn't trade in that range for long enough for us to do that. So right now we'll stay patient. We're not in a huge rush given the seasonality that we're seeing at the moment. We saw Macquarie come out and downgrade the banking sector today. People are now turning more negative banks. So you know how we are, Nick. We typically go against the grain a little bit. So if they came back to those levels for now, we would enact our 5% holding in Westpac and 5% holding in CBA. I would say Westpac's probably the one that we would pay up for before the dividend next week. So if there is one, it's probably Westpac, given that the dividend is looming. And
quickly, before we switch to resources, Clydesdale still a buy here for the investor that doesn't have exposure?
It's not as compelling as a buy, but I think it is still a buy. It's a medium-term play. We've got it in the portfolio for a medium-term play. So yeah, the thematics around that will play out over time. So yeah, not as high conviction buy as when we bought it, because it's obviously done well since we bought it. But yeah, I'd still buy it here.
Okay, and as I said, switch to resources now. Got BHP, Rio amongst other stocks in the portfolio. We have talked quickly about how BHP, if it gets through 24, it should shoot quickly towards 26. We've seen a little bit of support coming into that space, and are we expecting a bit of a bounce shorter term?
Yeah, I mean, resources had a lot of negativity thrown at them over the last couple of weeks. So, BHP, Rio have held up reasonably well. Some of the mid-tier plays have probably not held up as well as those guys. But when you get a heap of negativity thrown towards them, stocks, decline, but they hold up reasonably well. They don't get hammered. Then you often see when a little bit of positive news, a little bit of positive price action, the commodity complex comes through, then these stocks bounce pretty hard. We've seen BHP bounce pretty hard today, it bounced yesterday, so we're really comfortable with our positions in BHP, Rio and Oz Minerals. I know we're down on that Oz Minerals holding, but we're still comfortable with the underlying company. So we haven't panicked out of it, and it's up strongly today. Okay,
I want to touch on something else, a real positive, insurers. We've got Suncorp, our longest term holding. Hear a lot on the phones when we speak to our members and other investors out there that we're too short term for their liking. We have had Suncorp in the portfolio for quite some time, sort of nudging up towards 2 years. Done quite well out of it, had a lot of yield over that time, a lot of dividends, and we've also had a decent amount of growth. QBE sort of picked that up just after Trump got in, and that's been a really good stock for us too. Both are up quite a decent amount. I think QBE around the sort of 30% mark, and I think Suncorp with the dividends maybe similar. Now, what are our thoughts there? Is there going to be a time where we take profit on those stocks? We have talked in the reports as well that we probably anticipate another sort of 5 to 10% upside. Do you buy them as well if you don't have exposure?
Yeah, 14, 15 in QBE, 15, 16 in Suncorp would be the levels that we're looking for. Suncorp's, we've got 12% in Suncorp, so it's our most high conviction play in the portfolio. So it's great that it's going well for us. Because we've got 12%, we'll probably trim some of that out if it trades up to sort of that 15.50 level. I think that's probably a realistic expectation to make. We'll still maintain a reasonably large holding to see if it can get to that 16 level. I think it will. Technically, it looks like it will. I think there's a lot of drivers in the insurance space fundamentally that are improving. I've spoken about them on videos gone by, so I won't rehash it all. In relation to QBE, 1330 was broken yesterday. That's a really key technical level for QBE. So we've got a 4% holding, so not as big as Suncorp, but you combine those, we've got a massive overweight position in the insurance stock. So if they run hard, we'll take profits. There's no doubt about that. But right now, they look good technically. There's drivers fundamentally that are helping the business and earnings, etc. And the macro backdrop is supportive of these guys. So they pretty much encapsulate what we look for in Market Matters of those three things.
Okay, and next I want to touch on the retail space. You have written about it quite extensively in some of the afternoon notes recently. And I guess for a novice investor, it kind of looks like there's a bit of value there if you look at dividend yield, if you look at the PE. A lot of panic around Amazon potentially coming to our shores in the not too distant future. I think it was Citigroup that put a note out this morning and downgraded the space, and we've seen some further selling. Are we sniffing around for some opportunities here, or what is the Market Matters view on it at this point in time? Yeah,
it's getting interesting because everyone hates it. It's a sector that's been beaten up, but I think we're not there yet. For us, it's all too hard. So we don't know what the impact of Amazon will be. We know that Amazon sells a lot of consumer electronics. We know that's a large part of what they do. We know JB Hi-Fi has a really big consumer electronics component to their earnings. Harvey Norman looks interesting. It's 10 times. Myer's been smashed recently. JB Hi-Fi is still sort of 14, 15 times, but it's been re-rated from, it normally trades on a big premium to the market and a big premium to the sector, so there's been a big re-rate there. But I just think we haven't seen that capitulation sort of lows yet in these retailers. And for me, it is all too hard. Fund managers have got to have diversification in their portfolio. A lot of them have got to hold retailers, etc. We don't. We don't have to go into that sector. So, for me, I probably wouldn't be there at all. It's a little bit too hard for me at the moment. Another one to just finish on is Vita Group, VTG. We traded that very successfully in December. I think we took profit on that in early January. I think it's off today, 20-odd%? Yeah, down 30% today. I mean, that's a retailer as well. So they license the Telstra, they operate under the Telstra brand. They're licensed Telstra stores. And Telstra's had a change of contract with Vita. They've changed how they separate all their licensees and the structure of what they offer. So just goes to show, Vita Group, it was a short-term trade for us. We were in and out, made a quick 30%, but we weren't going to hold that longer term because the metrics of that business were very susceptible to a change from Telstra. So we've seen Telstra under a lot of pressure, Telstra's earnings under a lot of pressure. They naturally will go on pressure those businesses that are down the line that rely on Telstra, and that's what we've seen with VTG. So look, it's interesting now after a 30% drop. All the negative news is out there, so it's one we're watching, but not pulling the trigger on it just yet. Is there another trade in there short term, or not just yet? Yeah, I think there probably is short term, but look, we haven't had that. I'd like to see it trade for a few days around this downgrade, because there's going to be uncertainty around what this change in contractual obligation with Telstra means. And it's hard to see whether that's been priced in. A couple of days of selling, then we might get interested. Okay, thanks for the update, James. Thanks everyone for watching. Everyone keep their eyes peeled, if they already haven't seen it, for a seminar that we're running on May 30th at the Four Seasons. All our members are welcome to come along. We're happy to provide you some free tickets.
If you want some additional tickets, feel free to email us at info@Market Matters, or give us a call on the 1300 number, 1300 301 868. We'd love to see you all along. It's the first big event we're running. We're very interested in feedback. We obviously want to get this right so we can run more events in the not too distant future. Also got some great speakers that will be speaking on the night, and free drinks, so come along. Thanks for watching, everyone.